fundsupermart.com.
Chinese equities were shunted by investors over the last couple of years, but it appears that interest is recovering since December 2012. Can you share a view on this, as well as what DWS thinks about Chinese equity as an investment over the next 2 to 3 years?
We think the Chinese A-share market, the domestic A-share market, has a delayed response to incremental improvements in China's macro economy. Thus, we have seen a very strong rebound at the beginning of this year. When we look at the monthly macroeconomic data from last year, some leading indicators bottomed in June of 2012, and then it started to rebound in July, and then again in August. So the August data point basically confirmed that the trend of sequential improvement has been established. But keep in mind, the August data was reported in September. So starting in September, we expect the equity market should start to improve. Yet the A-share market was kind of consolidating from September to November and even declined further in December. I think that was just unreasonable, and it was not consistent with what we have observed from the economy. So we think the January rally now is finally catching on. Our outlook for the China's economy is for continuing economic growth reacceleration for the next few quarters. Our forecast for GDP this year is for GDP to grow by 8% this year compared to 7.8% last year. So obviously, we also expect the corporate earnings growth to accelerate this year. And so we expect there is a lot of investment values in the Chinese equities.
Based on information provided in the fact sheet, the DWS China Equity Fund does have a small exposure in the China A-share market. What is the maximum exposure to the China A-share market can a fund be invested in? And is the current allocation a limitation of the quota available, or is it a tactical allocation by intention?
Okay. The maximum exposure for this product for the A-share ETF is at 5%. We started to gain exposure into A-share ETF with exposure of 4%, so relative to the 5% maximum. We view this as an opportunistic investment for our fund because, as I said during the first question, there was a delayed response to the improving macro fundamentals from the Chinese investor. And so we took advantage of that, gained some exposure, and it's good that this play actually turned out to be a good trade. The market started to rally really hard in January. We also believe that the fundamental improvements of Chinese economy will be gradual. So we also monitor whether the market in the short term may rally a little bit too ahead of itself or pricing a rosy expectation for this year. So we actually, in February, trim a little bit position for the ETF. Keep in mind that the substantial majority of our China equity fund is to invest in offshore China equity, which are primarily listed in Hong Kong stock market exchange.
With a new leader in China recently, what are your views on the impact on the economy as well as equity markets? Is there any specific risk arising as a result of a regime change?
Sure. We feel that the new leadership should bring about a lot of changes to the China's economic system as well as social and even political systems. Compared to the previous generations of Chinese leadership, we believe the incoming leadership will place even more amount of emphasis on narrowing the income divide exists in China, and also the leaders are keen on encouraging private sector companies to develop and especially bring investments into sectors that are previously monopolized by the state-owned enterprises. So we believe that the new leadership will bring about even more changes to China and make China increasingly a market-oriented economy. And such change, if successful as we expect it to be, will make the China an even more investor-friendly place to invest in. For China, there is some structural challenges. That's part of the reason why Chinese stock markets sometimes underperform other emerging stock markets, despite China's superior GDP growth, right? So I think some of the structural reforms that we are anticipating under the new leadership will optimize China's economic structure and make the better progress in translating China's faster economic growth into the earnings growth of the public companies. So that should be positive for the Chinese stock markets.
There are a lot of talks of avoiding the Chinese financial sector. What is DWS view in this, and what are some of the sectors that you favor?
Within the financial sector, obviously it consists of banks, insurance companies, brokerage companies, and real estate companies. For banks, we believe that it will continue to grow, but in the long term, based on our expectation of continuing financial deregulation, banks' profit share in the overall market may decline. That means banks' earnings will continue to grow, but in the long term, some other segments of the financial sector may grow faster than the banking sector profit growth. What are the other segments that can potentially grow faster? For example, brokerage companies. China is undertaking reforms to further deregulate the financial industry, to encourage more direct financing relative to the banking sector's indirect financing. So we're going to see more and more financial innovations, and a lot of those innovations will be pioneered by brokerage companies. So for example, this year, we expect strong expansion of margin buying and also stock borrowing activities will be a major driver for brokerage companies this year compared to last year. So that's why in our portfolio, we gave more emphasis to brokerage companies compared to banks.